Pulver, apparently, who just took a trade on gold. It's the middle of the night. I'm not really sure how he did that. Pulver alerts are now available at A1Trading.com. Get exclusive access to Chris Pulver's trades with A1 Trading's Pulver alerts. Watch as Chris Pulver, a seasoned trading pro, navigates the markets, manages risk, and applies a disciplined trading process. Join today to level up your skills and learn from Chris's wealth of experience. Get Pulver alerts now.
Good morning, everybody. Happy Thursday. Nobody died, right? Yesterday was a pretty crazy day. Fun, long stream with A1 Trading and getting through FOMC and taking it right to the close. Pretty wild. I have a little visual here if you're interested in some whys and what happened. And it's, of course, after the fact. But look, we have the RSP, which is equal weighted S&P on one of the worst losing streaks ever in history. We have the Dow Jones down for 10 consecutive days, the worst losing streak in 50 years. We had the volatility index spike up 74%, which is the second largest single day move ever. The first largest was, you guessed it, August 5th. We had the CAPE ratio showing that the U.S. equities valuation, it's just, look, U.S. is 63% of total market cap. The CAPE ratio shows U.S. equities are now 86% higher than European stocks. I mean, this stretch-away move of how much better the U.S. is compared to others, this begs the question of, is the U.S. valued accordingly? Is it overvalued? Is there going to be a reversion? Is the U.S. going to start plateauing while other indexes and countries can start catching up? Or is it that there's cracks globally that are now going to start leaking into the U.S.? Like, there's no way that the U.S. can be immune to everything that's happening elsewhere. So just a little bit more of like a fair market search in the indexes. And monetary policy yesterday, I mean, Powell was surprisingly vocal on a couple of things. I mean, I did not expect him to go down to, I would say that was a bit of a rabbit hole for him yesterday to talk about tariffs and how it weighs on their decisions. He spent a lot of time talking about inflation and how it is higher than what they wanted. And even the target for inflation next year would be 2.5%, which is, again, no closer to 2%. Look, I mean, the numbers showed this year, like our CPI got as low as 2.4. And that's when the market was celebrating. We did have a victory lap coming to that September rate cut by the Fed. I think that victory lap was a little premature, as we can see with now 3 prints higher in inflation. Concerns mount as higher inflation expectations 2025 from the Fed funds rate end of year restrictive at 3.9. So you're looking at maybe 25 to 50 basis points of cuts next year, maybe. Geopolitical tensions, new axis, that's interesting there. China, Russia, Iran. We've heard about BRICS for multiple years now. Is it gaining traction? Is it gaining power? I don't know, maybe. Short bets are paying off. That includes me. I mean, I've been hedging now for months. Hasn't really paid off since August. But I did take some profit yesterday. I had a nice hedge on MES that I closed out for profit yesterday. I was I'm still watching my SPY hedge. I'm still watching my QQQ hedge. I have some out of the monies as well as some bear put spreads. Tesla and Nvidia, which we know market cap wise are pretty big, right? Tesla crossed over $1 trillion market cap. Nvidia is like the second or third largest company in the world. They had notable intraday price movements, heightened volatility, market uncertainty. So that's where we're at. Taking a look at the futures market this morning. This is the ES feed on top left. This is the NQ feed bottom right. This is our FOMC intraday sell-off yesterday. Just the market got smoked for those couple of hours from 2 to 4 p.m. One of the rare occasions that FOMC was just purely directional. It was initiated right at the 2 p.m. movement and just proceeded to go down all afternoon. But what did we do since then? Well, it looks like we bottomed out right around, closing bell, and we have been fighting back slowly but surely. But I will say this could be just a very simple bear flag. So you have this major drop, you have a little bit of pause, and then if the market is really eager to shed and go lower and volatility is going to continue to swell, then a bear flag move, if we get a breakdown here, okay, we could have more downside. So, it's always questionable, but it's like looking at the ES futures feed. I've got this box representing my 930 candle. I've got a nice little trend line break if we have a bear flag. If we get below this area, there's room to get down to yesterday's low. So there could be more, flows today to push us back down to the lows. If that is the case, we're going to continue to see IV, which is implied volatility, gaining higher. Right now, the SPX IV rank is 68.6. It was literally 7 2 weeks ago. It was 12 going into FOMC yesterday. It is now 68.6. That is a monster increase in volatility. That's what happens when the market is kind of caught off guard. And you can see that. I mean, it's really easy to see what the market looks like when it's caught off guard, right? Look at the VIX yesterday. One of the largest single day moves we've had since that August 5th, Monday. So where are we today? Well, somehow we faded halfway back and we're back to 22 instead of, opening up around 27. There's just, it's a very tricky instrument to trade, but this is why, based on your 30-day option prices in the S&P 500, this is the fear gauge. So when there's a huge move in fear and risk off trading, that's your VIX spiking up. And, if we look back and see like what was 2024's trading year like, there's a lot of takeaways from 2024. For the most part, we had a pretty simple trading year, with the exception of what happened late July into August, which was a volatility event that the market was happy to buy the dip on, but it was a little crazy because that was a very aggressive rush to the fire exit. On that, basically it was a Thursday to Monday. We had the SOM rule activated, which was, our what was it, 3-month employment trend was now trending higher than the 12-month, something like that. Like it's a weird formula. And then it was even discounted like a month later. It's like, oh, the SOM rule is not really accurate, even though it's been in this undefeated recession indicator for employment. Doesn't matter. But it was a Thursday, Friday, Sunday, or a Thursday, Friday, Monday. But the problem was over the weekends, futures market opens up, Japan opens up, all these crazy things happening with Japan. We had like a 17% drop in 2 days. We had a 27% peak to trough in Japan that absolutely dripped into the U.S. market aggressively. And we had that huge spike in the VIX. We had that huge, 10% flush in the S&P, 15% flush in the Nasdaq. That was August, right? Other than that, the year was pretty good. And what did August 5th look like? A crazy low, crazy high volatility, but everything got bought. And by the time we got to September, which is supposed to be the traditional September effect, all we had was a little sell-off the first Labor Day week, and it was back to all-time highs again. So it was crisis averted, so to speak. September, October, into the election. Trump wins, market moves on Trump. We go into all-time highs, 6, 7, 8 all-time highs out of the S&P, multiple all-time highs in the Nasdaq with no market breadth. And we had another volatility event yesterday. So how does it wrap up for the rest of the year? Well, I think it's going to be very difficult for the market to get to all-time highs. It's like that was a very damaging candle. This market doesn't look nearly as aggressive like it was here to kind of buy the dip. This was like, oh crap, we've had a great run. And I think that pretty much put the lid on the market for the year. I mean, anything's possible, but I am guessing with the amount of low volume that happens towards the end of the year, the only thing that would pay out for the rest of the year would be maybe some hedges, maybe some downside protection, or this is a break and a pause, and then we just wait and see where this market tries to pick itself up. Can it come back from a 3 to 4% sell off? Of course it can. Can it get worse? Of course it can. I don't know. But I will say that I'm still going to ride out some of these protective moves. We did have a nice strong close on the daily chart below the 50 moving average. Is there more room to come back into this post-election move? Look, the Dow has already erased the post-election run, right? Is the S&P going to follow? Look, this is crazy. This is the election right here. There's our post-election day gap. The Dow has filled it. We now have that big losing streak on the Dow that we haven't seen for over 50 years. And is this a sign of what the S&P and the Nasdaq is about to face? Maybe. Why would the Dow be so much worse as an index than the S&P and the Nasdaq? And granted, I understand like United Health Group is having its issues right now, and that's like one of the heavier weighted stocks in DIA. But I think everyone can agree that it's pretty overweight in the SPY too. It's all about the Mag 7. So let's take a look at Mag 7 stocks. And if they're not looking good, then we're probably going to have more pain, more pressure, at least to the downside. So Apple, we're up on the day for Apple. Amazon, we're halfway in between. kind of an indecision day, but a pretty nasty sell-off yesterday. Google, after ripping for those 2 or 3 days in a row, getting to fresh all-time highs, we had a pretty nice 2-day sell-off. Meta finally pulled back to a 21 period moving average. I still like Meta. This is another bar count that I'd be watching very closely. Oh my gosh, this is probably like an NVIDIA bar count. Oh baby. All right. Well, this is another stock I'm going to make a little claim here. Meta has gone 473 bars before we hit. All right, I'm going to say this. Meta likely hits the daily 200 EMA before hitting all-time highs. Okay. And I'm obviously a lot more comfortable saying that now after putting in some pressure like we did yesterday. This is 473 bars. NVIDIA is the same thing. Okay. It's the same thing. So it's a very high bar count. Rarely do we see stocks stretching over 300 bars, let alone 400 bars. It's 473 bars. We're going on nearly 500 bars. So I think best case scenario would be Meta's probably on borrowed time as far as going sideways, or there is more pressure to mount and have this thing unwind a little bit. Maybe it's a broader market move. I don't know. But where am I interested in buying Meta? Deeper, 100, 144, 200 moving averages, somewhere in here. I will say this. If we get a sell-off in Meta, I will start establishing more 1-1-1 positions on this one because I don't mind owning it cheaper. I also would consider either a 1-1-1 where I have a trap, or I would consider a ratio spread where I can buy a put and then sell 2 puts to potentially take some ownership, as long as I can get that ownership price maybe below $400. Okay. But I want to be careful on that because I don't want to have Meta could be my gosh, maybe it's a 50% sell-off. I don't know. Right? Like it would be a 18% correction to get back down to the 200 moving average. Okay, fine. But what if it gets worse? Right? What if we have like a 30, 40, 50% correction in high volatility stocks like a Meta, which we've seen before? 2021 Meta was down, right? When we peaked out in November 2021, got into the bear market 2022, Meta, it looks like it's so far away, so long ago, but this was a drop of 76%. So me getting excited about like, ooh, I can get a little 17% discount. Well, Meta can get a lot uglier than that. So maybe the best trade would be not to tie up like 100 shares of anything, not to get, really deep into the options trade, because I don't necessarily want to tie up $40,000 of cash on a stock that might have a deeper correction, you know? So there's my previous high. So that'd be a level I'd say, okay, Meta, maybe find some structure in there. That high to low, let me find this here. That high to low would be about a 39% correction. Like that's a starting point. I'd be happy to say rather than putting out $40,000 in cash, I'd rather spend $2,000, $3,000, $4,000 dollar cost averaging. Then I find a little bit more structure that I'm willing to trade. Then I start putting on my options positions and start to generate the income. Make sense? All right. Microsoft. We pulled back to 441. I closed out Microsoft. It was a 265 debit, closed out for 495, nearly hitting full profit. That was great. Obviously, right now it might be a little bit in jeopardy. It was a 12/20 expiration, which means tomorrow we're still, $6 clear of my strike. Even if I was still in the trade, it'd still be closing out for mostly profit. But I'm certainly happy I took the profit before we had the sell-off. So this trade is done. And, do I like anything on Microsoft? I do, but it's this. If we can't get back to the highs and Microsoft finds a way to get back down into these lows, the same type of thing. I want to have cash to deploy, probably dollar cost averaging in. I've got a 1-1-1 down here. I have a ratio spread as well. These are all fine for profit. They go out into, end of the year and Q1 of next year, but they're way out of the way. Okay. If we pull back into, I'm going to say 410 or lower, I'm way more interested in some positioning. So 410 DCA level. I'll just make a note of that. So if we fall back into the 200 moving average or fall back into some of these previous lows, I'm looking to see, can we, buy some more. Netflix didn't really move a lot. We had a nice sell-off day yesterday. Netflix bar count, not crazy high, but up there similar to the S&P and the gold move. 290 bars. So we'll see. Again, I'd love to buy some Netflix. Where at? Lower. Is Netflix $1,000 stock? Probably at some point, but I'd like to see it pull back to like 700s first. pull back into the 700s and then give us some gains to 1,000. That'd be nice. Nvidia trading at 129. I'm watching this one closely for the week. I'd made this claim let's see, 1210. So this would have been last week. Hits the 200 moving average, which is my red line in the daily, before we hit all-time highs. So far, that seems to be going the way I thought. We do have another very high bar count like we have on Meta. This is a trade that I'm watching the closest for this week. I might take some assignment on Nvidia, and if I do that on Friday with this ratio spread, my ownership price is 125. Now, what I will probably end up doing is, if I take the assignment on Nvidia, and I think this is going to be everybody takes this trade. So meaning my accounts here. So Nvidia, let's see here. Nvidia 132 by 130 right there. There's my ratio spread. So I would get the $2 bump, and I've got the credit on the trade as well. So let's see here. I'm looking to do the math on this one. So 307, 356. That should be 257 credit on the ratio spread. If assigned, I've got the $2 plus the 257. It actually should be lower than that if that math is correct. So I should have the assignment price 130 minus 2.57 minus 2. Yeah, that's right. Okay, 125.43 is the assigned price. Now, the first thing I'd be doing is, if I take the assignment where price is below 130 by Friday's close, the first thing I'm going to do with that assignment price coming into next week's trading is look out for a probably, 29 days out or 36 days out. I'll probably go 36 days out and take it to the end, or even 40 days out going to January, and look at Nvidia. Okay, actually, you know what? There's probably enough premium. I could probably lower it aggressively a couple weeks out. So, all right, let me just talk out loud here. So let's say I get the assignment on Friday and it hits my broker account on Monday. I go out to the 3rd of January. An at the money. This is fine. An at the money call out 15 days. I could get 5 to 550 for that, which means in 2 weeks' time, I could go from a 125 ownership down to a 120 ownership. If price falls below 120, I can do it again, and I can do it again, and it takes me maybe 2 to 4 weeks to bring my cost basis from 125 down to maybe 115. And if my cost basis is 115, that is my 200 moving average, which is exactly where I'd like to own the shares, and hopefully we get a bounce from there. That makes sense? So my goal is, if I'm going to take the shares of Nvidia, I'm going to try to repair this stock and also get, maybe a $5 net credit or a $10 net credit per share. So if I can walk away with $5, it's making $500 on 9 accounts. If it's making $10, it's $1,000 on 9 accounts. It helps. It's a nice little income play, and it maybe offsets some of the pressure that the market's dealing with right now with these these bearish moves and this bearish tension to the downside. But I could hopefully get enough premium on Nvidia. It looks pretty solid. So I'm kind of excited about the trade. Of course, if we get a spike up tomorrow and it gets back above 130, I don't take any assignment, and there's nothing to do, and I just collect the income. So we'll see. But if we're below 130, I'll take the shares, and I'll kind of take it with a smile on my face, because I'm pretty confident I can turn that thing into like a $5 or $10 winner. Right? Tesla, pretty big candle yesterday as well. More pressure to the downside. I'm still putting in my pending orders here for the Pulver alerts, trying to get into trade right around this previous high at 362.50. That's entry 1. So I'll say this. My goal right now is continue to monitor my hedges closely. I closed out MES. So I closed MES for profit. I have a SPY bear put spread. I have a QQQ bear put spread, and I have SPY out of the money long puts. And then I have NQ and MNQ long puts and bear put spread. Okay, a lot of these are 12/31 and 1/31 expirations. So I'm hedged out end of the year, end of January, just in case the market is not going to have the the resiliency that it did back in August, and maybe this is a little bit more pressure and more of a reality check with it being so concentrated at the top and all these things like I'd mentioned, this week in these A1 sessions, in my own YouTube sessions for my final hour at 3 p.m., there's a lot of crazy sentiment out there that retail traders are just so bullish and so optimistic. It's usually a contrarian play, and so this little move from yesterday is just like a really aggressive shakeout, right? And I'm wondering, like, does the shakeout have more teeth? It would make sense. Like, we haven't really hit any balancing moving average for a while. The 200 moving average on the daily time frame for the S&P is still like 290 bars away. It's getting to that point where we could stall and just maybe kind of meander our way down towards that 200 moving average before the market gets excited to buy again. Anyway, we'll find out. But my goal is right now, watch my hedges closely. Okay, I've got more. That's not just the only goal. That's fine, because none of those trades maybe none of those trades pay me, right? MES I close out for profit. My SPY bear put spread, if we don't stay below 590, I'm only taking a partial at profit. QQQ for not below 510, partial profit. SPY out of the money puts are like so out there and they're so cheap that I really need to see like another volatility type event. I looked at it this morning. I was up like $1,000 at the end of the day. Maybe I should have taken profit, but I didn't, because I'm like, oh, if we flush a little bit lower, but I'll just watch them. Period. I'm watching them. They're hedges. Now, the other thing I want to do would be map out levels that I'm interested in trading and investing. So, a lot of what I'm doing is going to be option trades. So, option trades with high IV. So, that would be basically, selling premium. So, I can collect income there. And also dollar cost average levels with affordable chunks. Right? So, rather than buying $40,000 in Meta at a $400 price, or rather than buying, and I do have this position, and I put this in the Pulver alerts, I put in a trade in Berkshire Hathaway. But if I were to take any shares of Berkshire Hathaway, I would own it at like a 17.5 to 18% discount. Berkshire Hathaway is almost like trading the S&P in a way. Like, it's pretty correlated. Obviously, it looks different because Buffett and Berkshire has been a net seller of stocks, and we went up to test some highs and we faded pretty hard. But if I'm looking at like buying Mag 7 or buying any stock or doing anything, I'd probably just start with like $500 chunks, $1,000 chunks, and look at maybe 3, 4, 5 levels that I'm interested in. Use some of my deployed cash. See if I can build up maybe, partial stocks where rather than taking on 100 shares at once, where I could control option trades, I can just dollar cost average and establish some investment pieces where I don't have to worry about time, and I get some levels that are notable discounts, right? If I bought, Meta 20% lower, but it's a dollar cost average level. If I bought MicroStrategy 20, 30% lower, if I bought Tesla 20, 30% lower, I think those are good starting points, right? So anyway, that's what I'm looking for. That's how I'm mapping out my trades for the rest of this year and into 2025. When Nick and I did our webinar on November 12th, we talked a lot about planning for 2025. And, this was one outlier. Like, is something going to break the market? And right now, it seems like we have enough of a downturn with the FOMC yesterday that's putting a lot of pressure and at least putting the bulls back on their heels, right? Like, the bulls have gotten fat this year. It's so easy to be a buyer. It's been so easy to be a buyer. And look, when you have leverage trading at the highest highs we've seen since 2021, when the market did topple over in 2022, that concerns me. You have crazy amounts of, spicy retail sentiment that's like the highest on record since the 80s. That concerns me. Like, it's a very simple, overloaded, crowded trade. And contrarian wise, it's easy to say you got to be hedged, you got to play some downside protection, and now it's starting to pay out. So the question is are these hedges, is this bearish sentiment like starting to really rise aggressively, or is it just like, okay, the bears had their fun, they got a nice little 3 to 4% correction, and now they're going to disappear? I don't know. Okay, but question for all of you is like, do you have a plan of what to do? Okay, I couldn't do any of this, by the way. If I was talking about this right here, it feels a lot better to say I'm mapping out levels to use cash that's been sitting on the sidelines than it was back in 2021 when I was still, on the euphoria run of like making so much money in 2020 and so much money in 2021 that I just stayed invested, and I didn't buy myself enough protection. And I was fully invested with zero cash available. And 2022 was more of a fight versus now it's like, man, I've got 45% cash on the sidelines, just collecting a little 4.5% kicker, and I'll deploy that when I think it's appropriate. So I've got cash at the ready. I'm letting prices come to me. I've been talking about it for weeks, and it's been frustrating to feel like I'm not participating in these higher highs and, watching Google rip $30, $40 in freaking 2 days and watching Tesla rip after the election, having 80+% gains in a month. It's like, it's insane what these stocks have done in the last month since the election. And certainly in the Mag 7 the last couple of weeks, because it's been the only thing going higher. But it's nice to have cash on the sidelines ready to deploy. And I think that the move yesterday kind of put that in action. So I feel properly positioned for whatever's coming ahead. I can obviously control my risk with small chunks here. I can control my risk with option trades, and we'll be fine. And if my hedges pay out, great. That to me is like the bonus. If the hedges pay out, great. It just offsets some of the drawdown and I can get the levels that I want. If the hedges don't pay out, that's fine. I've been I've been losing on hedges all year except for April, August, and now. And if somehow they disappoint me because it's low volume into the end of the year, that's fine. It is what it is. Okay. All right. Berkshire Hathaway. This is the trade that I put on. I did a ratio spread of 415 by 410. I collected 225. This is out to March. So, do we have more pressure? Yeah, maybe. Here's the stock. Here's a bar count. Do we come back and find the 200 moving average? Sure. Well, we're at 288 bars. So, Netflix has a high bar count. Gold has a high bar count. S&P has a high bar count. Berkshire Hathaway has a high bar count. They're getting up towards 300 plus bars. Okay. NVIDIA, Meta, almost 500 bars. Okay. Look at NVIDIA. NVIDIA, all the way back here in January 2023. Let me make sure I'm not skipping anything. So that would be my last touch of the bar right there, and about 480 bars. So yeah, Meta and NVIDIA, I could see them just slowly or quickly, doesn't matter, but like flushing their way down towards the 200 moving average. And this is a important level, as is this low and that 200 moving average plus that support. If NVIDIA breaks this, would I be like, oh my gosh, NVIDIA's, I don't know. I mean, NVIDIA is still pretty well positioned, but let's say NVIDIA comes down to test or break that August 5th low. Would that all of a sudden make it like I don't want to trade the stock? No. Look, I will walk you through everything I'm doing with this trade. If I'm taking assignment on NVIDIA and I lower my cost basis to 120 and lower it to 115, and it's the same thing I'm in with JD and Alibaba and Baidu. I'll still repair those trades and just keep collecting premium. But with NVIDIA, if I can lower it to 115, awesome. If I can lower it down here to the August 5th bottom at $95, freaking fantastic. But do I have to prepare? I mean, is NVIDIA going to drop 50, 60, 70%? I have no idea. I don't think so, right? I mean, it's not that hated yet. It's not that like the competition for NVIDIA is not that good yet to dethrone it. So I think that it was a bubbly story with semiconductors, and NVIDIA just for the last 10, 15, 20 years has actually become like the best performing asset in the world, which is, it's a lot. That's a lot of pressure put on a stock that was a little tiny chip company, and now it's a monster. But I'll try to get it to attractive levels. Do I want to own NVIDIA forever? No. I mean, I'm not one of the traders that can say like I've had NVIDIA for the last 10 years. I mean, that's great. And I, envy anybody that's had that in the portfolio. But if I've traded anything in the Nasdaq, which I've had NVIDIA exposure. If I trade anything in the S&P, I've had Nasdaq exposure or I've had NVIDIA exposure, by proxy because it's a market cap weighted instrument. So anyway, that's where I'm at. Let's take a look at the 10-year. What did I say I didn't want to see on the 10-year yield? I didn't want to see it going higher. Again, we're talking about this bond trade that is making the Fed, I don't know, eat their words, making the Fed. This is probably another reason that's going to make things tougher moving forward. Freaking A. I look at this going higher at another almost 0.9%, and we are now just it's the complete wrong direction. I mean, the Fed from this point has cut 100 basis points, and how many points are we higher on the 10-year? 96 basis points. This is literally the opposite of what the Fed has done in the markets. It's crazy. So this isn't a good thing. Look, there's big money behind this. I get it. I almost wonder if this trade is going to be, if things get worse, I could see it being in the bond market. If things get worse, it's like the bond market gets pushed down so low because yields are still going up higher. The pressure is on to take these yields up and these bonds down until ultimately it's going to force the Fed to react to something, right? If the Fed has to be reactive, that's when it gets concerning because the Fed's always been reactive. They've come in and they've saved the day and they've backstopped everything. But man, if there's a time in these next like 12 to 24 months where the Fed comes in and they backstop something and the market's like, you missed it, man. Like nobody cares anymore. That's I don't know. That's where we have like way bigger problems. So I don't know what to make of this outside of don't be surprised to see auto loan prices going higher, mortgage rates going higher, and as we get into the end of the year into Q1, I mean, other than the Fed saying we're going to be more restrictive, I don't know what this does. Like if this keeps going higher, even though the Fed is now like done cutting and they're going to be pausing, right? Like pausing until maybe May, June, July. Okay, like is that restrictive enough to turn this back down? I don't know. So I think if you're wanting to get a pulse of the market and kind of think a little bit macro and bigger picture, this is a really good chart because if this goes higher, it's going to put a lot of pressure on the overall markets. It's going to be tough for the markets, in my opinion, to gain higher highs, all-time highs, have a healthier bull market when we have higher borrowing costs on everything. Everything from little tiny consumers that are student loans and consolidations to refinancing a home, which nobody's going to refinance at a higher rate, to closing on a home at a higher rate, to houses that still haven't come down in price. So we've got unaffordable housing market, refinancing any debt for the business, refinancing or structuring any debt or servicing any debt at a higher cost for anything gets more expensive. Even servicing debt from the Fed level gets more expensive. So I think this is a really real chart to see that it's been fun, but the reality moving forward is I get that like the stock market doesn't necessarily reflect the real economy. I get it. We saw that disconnect, aggressively in 2020. We saw it in 2022. We've been feeling it for 4 years on Main Street, but here it is like, maybe Wall Street finally catches up. We'll find out. But this 10-year yield is going to be a really, really important chart to watch. Okay. All right. Futures wise, junk bonds. This is going to be a big drop. Yep. This is going to be your loosening in credit spreads. So your AAAs, your BBBs, your CCCs getting looser. Okay. Is this a concern? Well, that's another thing that I didn't talk about. I mentioned the last month or so, but I don't highlight and harp on this every single day. Our credit spreads from like AAA, BBB, CCCs were as tight as they were before 2007, before 2008's crisis. It's like that's how complacent this market was. So anyway, it's starting to loosen up a little bit. There's obviously a lot more volatility that came into the market yesterday, and we'll see where this ends up going. But keep a close eye on this one as well. So JNK, US 10-year, keep an eye on those. China stocks, anything exciting there? Not really. JD is down. I've got this thing rolled out to 38. SCHG, this is another one. This is Schwab dividend. This is Schwab growth. These are others that look. These are ETFs of anywhere between like 100 to 200 stocks. It's a little ETF through Schwab. Low cost structure. The expense ratio is pretty light, but they do pretty well. I mean, average dividend on this one's like 3 to 4%, and the growth one, obviously, growth has been killing it the last 3, 4, 5 years, 10 years even. But where am I looking at price levels? Well, this would be another one that I would look to dollar cost average into. So SCHD has been getting killed. That's the Schwab dividend, and then SCHG has yet to really give me a pullback that's meaningful. So I'll wait and see. Do I want to invest more at this? I mean, look, it's a $27 product. So why did I get interested this year in SCHD or SCHG? Because they did a stock split. So when this was trading at $200 and then it traded down to 20 some dollars, I'm like, well, it's cheap enough I can throw a couple bucks at it. So I did. Okay. Advanced decline line. Yesterday obviously was a nasty, nasty day. Everything went down. This is the total stock market declining, 6,000 plus stocks declining. Here is the NYSE, 2,000 plus stocks declining. Here's your volume, heavy volume to the downside yesterday. This is what I thought was interesting. So this is the S&P 500 with the 50-day moving average. And right now it shows that we have about 19% of the stocks above a 50-day moving average. Okay. You want to know what those stocks are? Well, I could probably name 7 of them. Okay. Maybe 6 of them. But very few of the total stock market, as far as the S&P 500 goes, very few are above a 50-day. Now, the reason this is important to me is this is another reason to justify if I'm going to deploy some cash, where would I do it? Because the last time we saw this thing really get to a bottom point where it's like, oh my gosh, only about 10% of stocks are above the 50 moving average. That means 90% of stocks are below it. That to me is a buying opportunity. So look at October 2023. If anybody knows what happened there, that was a pretty strong Q4 rip. Okay. Look at October 2022. That was an aggressive. That's what got us out of the bear market in 2022 was that October bottom. Okay. So same thing. It's like if this thing gets to like 10 or less, I'm going to start looking at a broader recovery. So is there still room to drop? Yep, there's room to drop. But I'm pretty interested if this thing gets down to like 10 or less. I'm going to start looking at either index trades. I'm not necessarily looking to be like a full-on stock picker for 2025. I think as we move forward, I want to have quality stocks over quantity. Okay, I like diversification, but I can diversify in the haystack, and obviously it's less volatility. There's less gain. It's like, yeah, it'd be nice to have a stock that goes up, 100%. Have a Palantir, have a Carvana, have a whatever freaking 100 stocks went up like 100+% this year. But if I can't pick those stocks, or I don't believe that those stocks are going to be sustainable, or those stocks that had such ridiculous rallies in 2024 are going to drop a ton, I'm not trying to pick them, And I think that's where traders get in trouble too, is you chase something. And interesting study, you go back like 50, 60, 70 years. If you try to be a stock picker, you ultimately lose. Like, because stocks will always rotate and businesses have cycles, and they have success and they have failures. And so, look, Palantir sounds great. It's been added into the indexes now. Congratulations, Palantir. But the stock's up like 180%, 200%. If it pulls back 30, 40, 50%, maybe deeper, well, maybe I'll throw some more Palantir. But I don't know. So I just think for me, it's like I'd rather survive in like, I know that I can take, if the S&P goes up 10% for the year, I can probably trade enough options around that to generate, 20% in gains. I can trade both ways. I can hedge. I can do income trades. I can do all sorts of stuff. I can trade the Qs and the SPYs. I can trade the indexes like SPX and NDX. There's all sorts of ways I can trade just the haystack and generate income and beat the benchmark. I don't have to be this crazy stock picker that's like, I've got to pick the perfect top or bottom on 1,000 stocks. It is exhausting, and it is lucky. And as far as buying and holding, it's luck, So I don't know. I've other than having like Apple since I got into college, or Netflix since I got into college, that was a nice like 20-year run. I mean, the little investment group that I ran, we had like 15 members, and we invested in stuff like that since the early 2000s. We participated unknowingly through like the dot-com crisis and the great financial crisis, and we just had time in the market, and we were like living, breathing testimonials to the 20-year history. That if you go back into any time in the stock market for over 20 years, there's never been a horizon that you haven't made money. You could have bought the absolute toppiest top anytime since 1929 and made money. So we did. Like we had 20 years in the market. Why did we stop trading? Well, my brother and some of the people that were in our club, their college closed, and so we had a bunch of professors. And when the college closed, their revenue dries up and they don't have a job, and so they're moving, and they are sitting on 6 figures of profits from this little investment thing we did for a while, and so they cashed in, and we all of a sudden went from having few $100,000 in cash to buy and participate to everyone wanted their money out. So we dissolved and it was fine. It was a good 20-year run. We made some good profits on it. But the lesson there was time in the market. And did we really know what we were doing? I mean, kind of. Not in the beginning. It's like I was a kid, but it's like I was interested. We followed some basic, newsletters and built some scanners and found some fundamentals and tried to identify some quality. We picked some stocks, but we really just participated in the haystack, which is the SPY, which is the Qs, right? So anyway, I'm just trying to make trading easier. It's like everyone. It just seems like we have so many traders out there that give me something leverage and I'm just going to try to, all I need is like 10 pips. I need 10 points. I need this. It's like everyone makes like thousands of dollars or loses thousands of dollars in a day. I mean, I was actually very happy yesterday to see that I had like almost $9,000 in hedges offsetting a $30,000 drawdown. So my drawdown was 20K yesterday out of 2.6. So 20K out of a $2.6 million portfolio, 0.7%, 0.76%, not even a full 1% drawdown yesterday. I can stomach that, you know? So anyway, it could be worse. It could always be worse. That's life. But anyway, I'll stop opining on pointless stuff. But what am I interested in? If this 50-day, this S&P above the 50-day moving average comes down into 10, I'm going to go ahead and set an alert here at 11. And now let's say interested in looking for bottoms, indexes, and quality stocks. Okay. And I might sacrifice growth, right? Like if I invest in the boring stuff like large cap, mega cap, Mag 7, I mean, everyone's like talking about like how the Mag 7 is going to fail and it should be a big rotation out of it. And maybe it is, but it's hard. It's hard to hate on stocks that make so much money every quarter and have basically a monopoly in every facet of their business. I mean, like life without Apple or Amazon or Google or Microsoft is a little bit more difficult to imagine. What I do on a daily basis is I sit on my computer, which is a Microsoft operating system, with my iPhone that sits in. It's like I check my iPhone all freaking day. With Amazon packages that are delivered anytime you want with the easiest convenience. With Google, with searches and YouTube, which we're running this on YouTube and YouTube. It's like it's so a part of our life every single day that are those companies going to fail? Probably not. Can they be hated on a little bit because they're so big? Yeah, but is the government powerful enough to break them all up? Doubtful. It'll just drag them through the mud. There's a famous saying from like this is back in like Stalin times, but it's like show me and I'll show you the crime. So look, if the government puts a target on your back, they'll drag you through the mud. Elon Musk is kind of that guy. He was at least, and now it's like, well, if Trump's president, maybe Elon Musk is getting a break. So anyway, whatever. All right, let's go some other stuff. And do I have anybody coming up after 11 o'clock? I'm good. I'm just talking today. I'm waiting. I'm still, like I said, I'm monitoring my hedges and watching positions. Probably the easiest trade for me right here is just to watch closely to see, does the futures market end up breaking, right? I mean, look, this time of year too, there shouldn't be a ton of volume in the market, right? There shouldn't be a ton of volume in the market. So I'm not saying that the market can't go lower. It certainly can. And volatility might get a little bit nastier, but all the volume. And like I said, yesterday was one of the last remaining catalysts for the year. The only thing that's left is Friday's PCE. Now, based on what the market already did, the Fed acknowledged it yesterday during Jerome Powell's press conference. We know that inflation is higher. If you're paying any attention to inflation numbers, or if you've lived life for the last 4 years, things are more expensive. Okay. But all we have is a PCE reading, which is supposed to be the Fed's preferred measure of inflation. And we still don't have a forecast on it. We just know that the previous year-over-year PCE was 2.8. And what do I imagine for tomorrow? What I read from the Fed reports is it's going to be something like 2.89. Let's call it 2.9. So if tomorrow morning at 8:30, this PCE year over year, we finally have some what? We finally have some forecasts. Well, there you go. This didn't come up at all. Okay, this wasn't here at all this week. So I'm looking at the news. Retail sales for Canada. Okay, this one I'm paying attention for the U.S. Yesterday, this wasn't even on the calendar. So, like I said, 2.89 was the measurement I saw from the Fed. So you can see that the core PCE year over year is projected to be 1/10 higher, which is higher than the previous, which is just along the same lines as watching PPI go higher and CPI go higher. The PCE price index year over year 2.3, now forecasted 2.5. Okay. And again, in the fancy accounting economist world of an economic calendar, is it going to come in exactly as forecasted? Is it going to come in higher or lower? Right? So I would imagine higher is probably the trend because we've seen it for the last 3 months, September, October, November to now. It's like all those prints since September's data printed in October, all of it showing higher inflation, CPI and PPI and PCE all higher. So those are your forecasts for tomorrow. That's it. Like once we get through this, it's Christmas and it's New Year's and it's low volume. It's going to be an interesting market to navigate. I will be spot checking, but how active am I going to be? A lot of my positions are out to 1231 or 131 for hedges. If I have chart alarms set, I've got, TradingView with my membership, I've got 400 plus chart alarms I can set. Believe me, I'm setting them on levels and stocks that I'm interested in buying. And so I'll participate. If I've got a level, I'll participate. I'm not traveling for the holidays. So yeah, but tomorrow's inflation news, like, is the market going to react to it? Maybe, maybe not. Maybe the biggest reaction was this week on Wednesday, and then it's just more about like how the market digests the news. But we are showing here on paper that the forecast is higher inflation. Okay. The yields have gone higher. So I don't know. It's tricky to look into to early 2025. If we did not have a sell-off yesterday and we were sitting near all-time highs by the Fed, I was thinking like Christmas, New Year's, we're going to drift to all-time highs, and this market just keeps melting up, and then we'd have like an interesting shakeout early in 2025, thinking maybe the debt ceiling is going to be the potential catalyst, but it's not. The Fed caused it, right? That's the excuse that the market's using. But believe me, there's plenty of hedges that were going on. I know a lot of funds, a lot of macro, a lot of people were hedged, right? Good investors were hedged. Buying puts was dirt freaking cheap. I know it because I've traded them. There's a reason I couldn't turn away from having at least like a 30 to 60-day hedge because it was so cheap. And yesterday was the day where it's like it looks pretty good. Even though it could have been a wasted money, it still looks pretty good to have it when you're right. Anyway, we are sitting here looking at higher inflation. The market's going to struggle, I think, to get back to all-time highs for the rest of the year. So where are we at? Where does that leave us? Well, that leaves us with potentially more pressure to the downside, maybe a bit of a holiday meltdown, which is unusual, right? Usually it's like the Santa rally, Christmas and New Year's. Look, I don't know how much buying is coming in over the next couple of days, right? And if we don't have any like major buying to the upside, I don't know how this market does anything more than either go sideways or just slowly unravel. If it gets more accelerated, let's keep an eye on it. But otherwise, with low volume and the holidays approaching, don't expect to have a lot of fireworks and crazy movement. I could see that the pressure is now in. Like, I think a lot of traders would say like the top is in. After yesterday's kind of cementing that, it's going to be very difficult for this market in 2 weeks of low volume holiday trading to somehow snap back, 3.5 to 4% to get back to these highs. So where do we go from here? Well, dynamically, if the Dow has come right back in to fill this election gap, guess where I think the SPY can go? Right there to it. So can we come back into the election gap? Yep. And that would be a 100 moving average. Can we come back deeper than that and take out the election? Yeah, maybe we could take out that pre-election low, maybe find the 144 moving average. I'm going to start positioning a little bit more aggressively with a 144 and a 200, and obviously my structure here, which is connected to previous lows, which would be a little bit below the 200. And then everyone's going to be worried about the death cross, and typically that death cross becomes a fake out. If there's any way to keep this bull market going, and what's everyone expecting for 2025? That it should get better, right? We're going to have lower taxes. We're going to be, pro deregulation and pro capitalism and pro everything and pro blah, blah, blah. It should be okay. But that's being said, not being seen. Like, I don't know what's going to happen in 2025. It is a clean slate, and I said this yesterday during my live session. I don't know if I said this when Nick and I were on. But I ran a bonus session afterwards on my YouTube channel, and I thought, think about how interesting this could be for 2024 and 2025. We could have this market for the end of the year give us right now we're down about 4%, give or take, like 3 to 4%, right? So let's go high to low. We're probably down about 4% from the high to low. Okay, about 3.68% in the S&P. I think it's over 4% on the Qs. Now, we have room to still give back some of our gains for the year, and this market could still be 20+% on the SPY. It could be 20+% on the Qs. It could be, 15 to 20+% in gold. It could be 75 to 100+% in Bitcoin. It's still going to be down in the bond market. That's going to be like a 4-year drawdown or something in the bond market, which is like unheard of, and it rarely ever happens. But point is, like, overall investing could still be seen as, like, on paper, that's still a heck of a year, because you have to remember, the average return is 8 to 10%. So this is still crushing it for the last decade plus. This is a great year. So what I think is interesting is we could still have, 4, 6, 8, 10% corrections in these markets and still have a good finish to the year in 2024, and also even offer up a discount to start 2025. And if we have a discount to start 2025 and all the market does is just work its way, whatever it takes to get its way back up to those highs, we could have a little bit of a discount to then buffer the gains in 2025, because 2024 had all the slack to give some of it back, right? So we could have like the discount offered in 2024 into early 2025, and then the market fights back. So you still have a solid 2024 with the ability to deploy some capital to have a positive 2025. That already, it's pretty optimistic. I think that's a good thing to look forward to as a trader next year. If we're getting a discount, great. You can get stuff cheaper. That makes sense? So I don't think this is all lost. It's like, oh my gosh, what do we do? It's just going to get worse. It's like everyone thinks it's going to get worse. Everyone thinks this market's going to die and it's going to zero. And like the sentiment swings are so insane to me. And that's why I was getting really, really toppy. Like I was questioning like how much higher this market can melt up, because like everything is so pinned one way. And so, yeah, there's your reality check. It happened. Now what's left? Maybe some more downside. Cool. Well, we still have the ability to hang on to gains for 2024. And then we have the ability to buy some really good discount levels. And even if the market goes from low to high and low to high, in 2025 is a grinding year, but it establishes some type of structure. Maybe a broadening pattern would be a little trickier to trade, but it could be a trader's year in 2025, and we'll figure it out. Okay. So point is, pay attention. There's going to be stuff to trade. There's going to be opportunities. I would say just a word of caution. If you are leveraged on anything, like you're leveraged ETFs, you're speculating on garbage and penny stocks, you're, having these huge drawdowns and you're sitting and hoping and praying that things come back. Well, good luck. I just had somebody send me a screenshot yesterday, $50,000 account. $8,000 was the result after yesterday's trading. $50,000 account was sitting at a balance of $8,000 after yesterday's trading. Like, how irresponsible is that as risk management? Like, that is tossing in, it's all on the line. Like, you might as well go to the casino and put it all on black. It's like, that's terrible. It's not trading. That's gambling. That's straight up gambling. So I'm just saying, don't be that trader. It's not that hard to practice some discipline and patience and risk management. And what you have to give up is you got to give up the allure and the dream of your, $1 million overnight. You got to give up the FOMO of like, why can't I make $100,000 in a day because I went all in on a call option? It's like, give that shit up and focus on good quality trades, and you'll survive and you'll be fine. Okay. All right. That being said, my one swear word of the day, I'll let you go. All right. Thanks. We'll see you soon.